Hello everyone. Today we're going to study about source of finance, and the subject is called financial management. This subject is divided into two parts. So today we learn about first part. The topic list contains 5 plans. First, short-term source of finance, and second, long-term debt finance. Today, in this presentation, we'll learn about these 2 plans. So, in this presentation, we will look at the distinction between short and long-term source of finance. When source of long-term finance are used, large sums are usually involved, and so the financial manager needs to consider all the options available with care, looking at the possible effects on the company and the long term. If a company decides to raise new equity finance, it needs to consider which method would be best for its circumstances. Also consider here is the growth area of Islamic finance and how it differs from the other forms of financing covered. Okay, first, short-term finance. Short-term finance is usually needed for business to run their day-to-day operations, including payments of wages to employees, the inventory, ordering, and supplies. Business with seasonal peaks and troughs, and those engaged in international trade are likely to be heavy users of short-term finance. A range of short-term sources of finance are available to business, including overdrafts, short-term loans, trade credits, and short-term leases. Overdraft. What's this? So, where payments from a current account exceed income to the account for a temporary period. The bank may agree to finance a deficit balance on the account by means of an overdraft. Overdrafts are the most important source of short-term finance available to businesses. They can be arranged relatively quickly and offer a level of flexibility with regard to the amount borrowed at any time, while interest is only paid when the account is overdrawn. Overdraft has a certain properties. For example, the amount. The bank specifies an overdraft limit. The overdrawn or negative balance on the account cannot exceed this limit. The bank usually decides the limit with reference to the borrower's known income. Overdraft borrowing is through the borrower's normal business bank account. And margin. Interest charged at the bank's administrative base rate plus margin. This rate is usually higher than the rate for a short-term bank loan. Interest is calculated daily on the amount overdrawn, and it's charged to the borrower's account quarterly or monthly. An additional fee may be charged for arranging a large-size overdraft facility. Purpose: generally to cover short-term deficit in cash flow from normal business operations. The borrower may not want to retain large amounts of cash in a bank account, earning no interest. Therefore, some negative cash balances may occur. Repayment, technically repayable on demand. If a bank ends an overdraft facility without warning, the borrower could face a risk of insolvency. Security depends on size of facility. The bank may ask for security, but often does not. Benefits: the customer has flexible means of short-term borrowing. The bank has to accept fluctuations in amount of lending. Short-term loans, the second part of this. A term loan is a loan for a fixed amount for a specified period, usually from a bank. The loan may have a specific purpose, such as the purchase of an asset. It's drawn in full at the beginning of the loan period and repaid at a specified time or in defined installments. Term loans are offered with a variety of repayment schedules. Often the interest and capital repayments are predetermined. Overdrafts and short-term loans compared. If we compare them, a customer might ask the bank for an overdraft facility when the bank would wish to suggest a loan instead. Alternatively, a customer might ask for a loan when an overdraft would be more appropriate. In most cases, when a customer wants finance to help with day-to-day trading and cash flow needs, an overdraft would be the appropriate method of financing. The customer should not be short of cash all the time and should expect to be in credit in some days, but in need of an overdraft on others. When a customer wants to borrow from a bank for only a short period of time, even for the purchase of a major fixed asset, such as an item of plant or machinery, an overdraft facility might be more suitable than a loan because the customer will stop paying interest as soon as their account goes into credit. Trade credit. Trade credit is a major source of short-term finance for a business. Current assets such as raw materials may be purchased on credit, with payment terms normally varying from between 30 and 90 days. Trade credit therefore represents an interest-free short-term loan. In a period of high inflation, purchasing trade credit will be very helpful in keeping costs down. However, it's important to take into account the loss of discounts suppliers offer for early payment. Leasing. Rather than buying an asset outright, using either available cash resources or borrowed funds, a business may lease an asset. Leasing is a popular source of finance. Leasing can be defined as a contract between lessor and lessee for hire of a specific asset selected from a manufacturer or vendor of such assets by the lessee. The lessor retains ownership of the asset. The lessee has possession and use of the asset on payment of specified rentals over a period. Short-term leases are a source of short-term finance for non-current assets. And the second plan is about long-term debt financing. Long-term finance is used for major investments and is usually more expensive and less flexible than short-term finance. A range of long-term sources of finance are available to business, including debt finance, leasing, venture capital, and equity finance. Long-term debt finance. So sometimes business may need long-term funds, but may not wish to issue equity capital. Perhaps the current shareholders will be unwilling to contribute additional capital. Possibly the company does not wish to involve outside shareholders who will have more onerous requirements than current members. Other reasons for choosing debt finance may include lesser cost and easier availability, particularly if the company has little or no existing debt finance. Debt finance provides tax relief on interest payments. Source of debt finance. Okay, one of them is if a company does wish to raise debt finance, it will need to consider what type of finance will be available. If it's seeking medium-term bank finance, it ought to be in the form of a loan. Bank finance is an important source of both short-term and long-term debt for small companies. Second, if a company is seeking to issue loan notes or bonds, it must decide whether to make an issue of conventional loan notes or whether investors may be attracted by a different type of loan note issue, such as convertible loan notes. Factors influencing choice of debt finance. The choice of debt finance that a company can make depends on the size of the company. Public issue of loan notes is only available to a large company. The security that can be offered and the security that may be demanded by a lender. The duration of the required financing. And then whether a fixed or floating interest rate is preferred. Fixed rates are more expensive, but floating rates are riskier. And loan notes are long-term debt capitalized by a company for which interest is paid, usually half yearly and at a fixed rate. Holders of loan notes are therefore long-term payables for the company. The term loan note or bond describes various forms of long-term debt a company may issue. They may be redeemable or irredeemable. Bonds or loan notes come in various forms, including floating rate, zero coupon, and convertible. Conventional loan notes, they're fixed redeemable securities. Loan notes have a nominal value, which is a debt owned by the company, and interest is paid at a stated coupon on this amount. For example, if a company issues 10% loan notes, the coupon will be 10% of the nominal value of the loan notes, so that $100 of loan notes will receive $10 interest each year. The rate quoted is the gross rate before tax. Deep discount loan notes, one of the types of loan notes. Deep discount loan notes are issued at a price which is a large discount to the nominal value of the notes, and which will be redeemable at nominal value or above nominal value when they eventually mature. For example, a company might issue $1 million of loan notes in 2011 at a price of $50 per $100 nominal value and redeemable at nominal value in the year 2019. The coupon rate of interest will be very low compared with yields on conventional loan notes with the same maturity. For a company with specific cash flow requirements, the low servicing cost during the currency of the loan note may be an attraction coupled with a high cost of redemption at maturity. The low coupon loan notes are issued at a discount to their redemption value, but no interest is paid on them. Zero coupon loan notes are an extreme form of deep discount bond. For example, a company may issue zero coupon discount loan notes at 75, pay no interest at all, but at maturity, say 5 years later, redeem the loan notes at 100. The investor gains from the difference between the issue price and the redemption value. $25 per 75 invested. There is an implied interest rate in the amount of discount at which the loan notes are issued, or subsequently resold on the market. Convertible loan notes give the holder the right to convert to other securities, normally ordinary shares, at a predetermined price, rate, or time. For example, the conversion terms for a convertible loan notes may be that on 1st April 2010, $100 of loan notes can be converted into 40 ordinary shares, whereas on 1st April 2011, maybe the conversion rate is 45 ordinary shares per $100 of loan notes. Once converted, convertible securities cannot be converted back into the original fixed return security. The conversion value and the conversion premium. The current market value of ordinary shares into which a loan note may be converted is known as the conversion value. The conversion value will be below the value of the loan note at the date of issue, but will be expected to increase as the date for conversion approaches. on the assumption that a company's shares ought to increase in market value over time. Conversion value is equal to conversion ratio multiplied by market price per share. Conversion premium is equal to current market value minus current conversion value. Okay, here is example question. The 10% convertible loan notes of Star White are quoted at $142 per $100 nominal. The earliest date for conversion is in 4 years' time at the rate of 30 ordinary shares per $100 nominal loan note value. The share price is currently $4.15. Annual interest on the loan notes has just been paid. Required: calculate the current conversion value, and second, calculate the conversion premium and comment on its meaning. Here's the answer. Conversion ratio is $100 loan note equal to 30 ordinary shares, and conversion value is 30 multiplied by $4.15, and it's total $124.5. Conversion premium is equal to so $142 minus 124.5, and the result 17 and 50, or 14%. The share price will have to rise by 14 before the conversation rights become attractive. And this is in general about source of finance, and about the first lesson. You can study these things from the internet and from the main book. It's only in brief and short explanation about this. So the first part of our audio lesson is end. Thank you, everyone.